David Keller is joining us this morning. He's the chief market strategist at stockcharts.com. And David, let's start with one group that has been powering this rally. It's semiconductors. Is the strength still building here? Tell me what you see.
Yeah, so thinking of all the different areas of potential leadership, semiconductors tend to be a really good group to follow because they just tend to do really well in bull market phases. They tend to struggle when the market's not doing well. So looking at the relative performance of semiconductors versus the rest of the market tends to be sort of a good market tell overall if you have to look for one. So what we saw in April, what we saw in July, strength in semiconductors, new price highs, relative strength really, really strong. And overall, I think we're seeing a very similar pattern now. They've been sort of choppy sideways earlier in the year and then have now completely resolved to the upside, consistently breaking to new relative highs. So the only potential issue I see from a technical perspective, I mentioned in April and in July, you had that same configuration, a break to new price highs, break to new relative highs, and then a little bit of a pullback. But overall, it's always resolved higher so far in the last year. So that's what I would probably expect here.
David, as it pertains to sort of the fundamental side of this as well, and the strength of semis, instead of the sort of warning signal sent by some of the safety assets like bonds and gold, have been a pretty good tell. It's kind of the way they worked in 2018 when they got slammed, and then the rest of the market was like, oh, I guess the economy is not growing around the world as fast as we thought. The synchronized growth story was a bunch of baloney. So what needs to happen, what follow-through needs to happen to keep semis going, though, because the breakout relative to the S&P that you're showing here, I think, is definitely worth noting.
Yeah, and so I would say from a technical perspective, it's very easy to get caught up into, the bottom of the page being support and the top of the page being resistance. And you have to remember that trends can persist much longer than you think might be reasonable. So just because it's broken to new highs doesn't mean that can't continue for a long time from now. And so I think consistently, if you look back over time, there have been a number of times where semiconductors break out on a relative basis. That ends up being the beginning of a sustained move in stocks. And I think the lack of a breakout from semiconductors, I think, was one of the warning signs or potential warning signs, along with weaker breadth, lack of confirmation from small caps. And one by one, we've seen each of those sort of warning signs sort of dissipate. And I think the relative breakout in semiconductors was the first of a number of them that we've seen sort of supporting more of an extended bull move here.
Okay, David, there's an easy transition here to another chart, which is looking at the rest of the world's equity versus the U.S. stock market. The best house narrative of the U.S. data and the U.S. central bank still easing, even while our data has been strong relative to the rest of the world, has been a huge bullish cocktail. Now, it looks like perhaps around the same time that bond market bottomed out in yield, peaked in price, we've got a little bit of a turnaround here in leadership. What say you?
So I always like to look for what I'd call the pain trade. And it's been said that the market will move in whatever direction will cause the most pain to the most investors. So I'm always looking for something that would be a potential pain trade, some place that people might be caught on the wrong side of things. And I think a continued underperformance of the U.S. versus the rest of the world that's just maybe emerged in the last 4 to 6 weeks, if that would continue and you continue to see global markets start to look more attractive than U.S. markets, and that would persist for a little while, I think a lot of investors have been very comfortable sort of ignoring markets outside the U.S., just thinking of dollar strength and not having to really be considerate of that. And if international markets really start to outperform U.S., you're leaving a lot of alpha on the table by not having any exposure there. I think institutions as well. Institutions have gotten very comfortable with having a very small and not very meaningful exposure to international markets for the last couple of years. If that would continue, if this trend would continue, sort of go lower, I think a lot of them would get caught off guard. And what happens when that happens is you have an influx of flows into international markets to overcompensate. That will continue the trend a lot further than you might expect. Now, right now, this relative chart showing the U.S. or the S&P starting to underperform ACWI or the All-Country World Index over the last couple months, it really is a dollar story, I think, for the most part. So you've had a pullback in the dollar 2 times previously this year. Both of those have obviously resolved higher. This is potentially the third pullback. So if that pattern continues, we're in sort of the weaker part, and you would expect an emergence to the upside. So the pain trade for me is that line continues lower. U.S. markets continue to underperform. The dollar potentially breaks down. That would be an unexpected behavior, and I think a lot of people would get caught on the wrong side of it.
David, this is a huge point. I would make a case that possibly that chart, SPY versus the ACWI, the ACWI as you call it, is one of the most important charts right now because it represents possible breakage of the biggest trend the last 18 months, which has been the U.S. best house story, the strong dollar, the idea that rates are pinned because yields around the world are so low to compensate for the weak growth, that there's a lot that goes into this, and the dollar would be another one. So far this morning, interestingly enough, what we're seeing with trade progress headlines is a stronger dollar. So from a technical perspective, tell me what you want to see for the US dollar that would impress you from a bearish standpoint. I mean, at what point do we say, okay, this trend has turned? Because the dollar has just been tough to knock out of its place.
That's exactly right. So when you're looking at the dollar, again, I think the pattern that we've seen previously this year is a pullback of X percent or so, a pullback maybe to the 200-day moving average. If you look at the daily chart of the dollar, each one of those times has resolved back to the upside. I think if that pattern breaks, and we've seen just a little bit of a rise in the last 2 weeks, sort of a bounce off the 200-day. If that holds, I think the dollar remains in a pretty positive position overall. The long-term trend is undeniably higher, with higher highs and higher lows on the weekly chart. But if we would see that fail, if we would start to see lower highs, lower lows, and a breakthrough of support. So on the dollar, that's around 96.75 or so, would take us to a new swing low. I think if you get follow through below that level, that would be below the 200-day moving average. That would be a very different configuration than what we've seen. I think that would validate more of a bearish dollar thesis, and I think a lot of other things would start to evolve as a result of that. But at this point, it's all about that 200-day moving average around the 96.75 to 97 level. That's really the key support right now.
Okay, a great answer on the dollar chart here. Let's keep going with the charts that we had planned, David. When you look at what's happening in the sector basis for the U.S. stock market, part of this that's all going together, right? This all fits together. This narrative that we're describing here is the strength in financials and banks. Has that reflected true breakout in your mind?
So I think one of the holding patterns, or one of the potential issues with the market, you saw semiconductors doing so well, which is a great bullish tell, but you really didn't have a confirmation from financials. And if you look at a chart of the XLF, it's this huge basing pattern, multi-year basing pattern, a resistance level that really had not been eclipsed. And every time the XLF sort of pushed up to previous resistance, the resistance held. It didn't get any further. And obviously there's a lot driving that. But if you look at the charts of the big banks, things like JP Morgan, Goldman Sachs, and others, Bank of America, all really emerging, breaking to new highs. I mean, if you knew nothing else in the world and just look at the chart of JP Morgan, you'd probably feel pretty good about the overall equity market, because it's going up and to the right, long and strong, consistent breakout and sustained breakout. It's now holding up very, very nicely. Looking at a chart of the XLF, I think all of those banks are sort of adding up and really pushing the index higher. So the financial sector in the form of the XLF now has broken above a multi-year resistance level. They always say, Ralph Akinfor, one of my mentors, would say the wider the base, the higher in space. And this has been a multi-year base that is now broken out. I think that speaks to continued strength from financials, which I would argue should speak to continued strength for the overall equity environment. So, some of those things, I think some of the things like the XLF, semiconductors, now all starting to emerge and confirming higher highs in equities makes me feel much more comfortable as a technical investor, thinking about the trends that are sort of becoming more wider spread now.
Okay. Hey, real quick, David, I love the macro, but let's talk a stock pick real quick. You're a fan of Walgreens Boots, so if we're in the market here for a discussion about rotation, nobody would like it more than Walgreens, because that thing has been in need of a turnaround in its direction.
That's exactly right. I think, it's interesting. If you look at the stock level, I always tell my my followers, look under the hood of the market a little bit. It's so easy to get caught up in the big picture. But if you look at the micro level, there are plenty of opportunities. And just within consumer staples, you have a stock like Walgreens Boots Alliance that's been beaten down. But now all of a sudden you see this transition. On the left half of that chart, it's a real distributed phase, lower lows, lower highs. You then have this consolidation from maybe last April to the beginning of the fall. And then in the last couple months, look at how that's reversed. Now you see higher highs, higher lows, a breakout, or sort of a follow through to the upside this week, breaking back above the 200-day for the first time since the beginning of the year. So I think that's pretty interesting. And if you look within staples, you have a lot of stocks that look very different. Something like Hershey's, sort of the complete inverted picture, lower highs, lower lows, breaking down through support. So I like stocks that are merging in an area of market weakness, because that shows you there's opportunity. and potential for further upside. So within staples, there's some really interesting, I think, potential pair trade opportunities there.
Okay, love it. Hershey's to the downside. Walgreens Boots Alliances looking up. David Keller, we got to run. Opening bell in 42 seconds. Really nice hit on all the big macro stuff to watch. David Keller is a chief market strategist at stockcharts.com.